Good morning, everyone. Sound check 1 2 3 1 2 3. If you can hear me, please type it in the chat box so I know that we are good. Thank you, Mark. Thank you, Christian. So take a moment to read this disclaimer. My name is Josip Kasek. This is Options with Osha. And I want to make sure you can hear me. Please type it in the chat box so I know that we're good. Just 1 second. I was just checking that everything is good. So we are not financial brokers. Everything is for educational purposes only. And let me show you where you can get in touch with us. This is our website here. It's been recently fixed. Usually I post my live notes right here. So that's what I'm planning to do today. And I would like to share with you the big picture, what we're going to do today. So this is an agenda that I prepared for this morning, and I'm going to be taking notes here. And it's been a quite while ride in the market, and I'm going to go over the big picture. I'm not going to spend too much time, perhaps maybe like, I would say like less than 10 minutes, right? And then I want to address the question that Mark, I'm glad you're in a session here, addressed me, because I sent him an email about how do you fight against this down market if you have an IRA and you can't go short an IRA. So I have a bunch of inverse ETFs that I personally trade, and I'm going to introduce them to you. And I'm planning to finish up the session with the broken wing butterfly. So if this is good to see you, Ahmed. Thank you for coming. I'm going to now jump into the big picture. So the big picture starts as always with us looking at monthly charts just to see how those lows that I've been talking about since the February 24th have been violated to the downside quite decently. So I'm going to go over the over the Dow Jones first. So this is a diamond, and this is the low of the February 24th, and we are dead on it right now. Now you would notice this blue line that I had drawn was accurate because it was connecting that low back in March 26th of the 2020, which coincidentally is very interesting because when we turn around in 2008 crash, it was also March 26th, so it's interesting that the March 26th in both cases was relevant here. And then I went up here, so this is January, February, March, and I connected with the low of the March, and I also have connected here with the low of the April, which of course got violated in the month of May, and now we're sitting right dead on the low of the February 24th. Where this bar is going to close, we don't have a yet certainty, but this is the current situation as of May 10th. Moving on to the QQQ or a technology, you can definitely see that the May month has already taken out that low of the February 24th. It closed down with conviction, and we are currently trading way lower. That there was an attempt to go back above that February 24th. We moved violently above it, but then we came right back down with violence too. So as of now, this is a downtrend on a NASDAQ. If somebody asks you between these two, which one is the weaker one, it's definitely the QQQ, because we can assume on a Dow Jones that perhaps on a Dow Jones we could consider that low maybe even as possible support. So let me just now show you quickly what the market is doing this morning. I have a FinViz open here, and I just want to show it to you here that somehow we have an anomaly this morning on the market, that the NASDAQ is still somewhat up while the Dow has come down and filled the gap. So did the S&P. So let's just move on to the S&P. S&P is right here on a chart, also monthly, showing to us that it has broken that February 24th low with the conviction. And we have a complete synchronization because also the Russell 2000 has completely collapsed and it has moved lower. So I have now finished this big picture 10-minute kind of explanation of what the big market is doing. And what I would like to do now, I would like to point out to you that I have in mind to discuss the inverse ETFs. So one of the things that I have shared with Mark when he reached out to me, and I really appreciate that, was this particular document that it shows the leverage ETFs, right? And the way how I have picked that up is that I have simply Googled ETF leverage, and I have gotten the information about it. So let me just explain to you what you're looking here. You're looking at the Dow, obviously over here with the U, that's Ultra Dow, and then you have a DDM, which is an extra one. So what I did that particular day, I was looking if the Dow was down, then what would happen with this one, Ultra Dow, that was down 6 times, so 2%. Dow was down that particular day when I did the research 2%, which means 3 times that. That's the Ultra Dow. It was down 6%. So be aware of it that you can trade this in the same direction. But the question that Mark asked, and I really appreciate that question, Mark. If you're there, just give me the little check mark so you know that I'm delivering what I said. Is I looked into the inverse. So inverse ETFs for the Dow are called Dows of Dog, dogs of Dow, right? This is a dog, then you have a DXD, and then you have a SDW. Now notice I have already thrown at you 5 different Dow components. That doesn't mean that I trade all 5 of them. I actually trade just one of each, but I just want to explain how this thing worked, right? So that particular day when I was looking, the Dow was down 2%, which means on the inverse, the dog was up exactly 2%, but to the upside. Now, then you have a DXD. D stands for a double times Dow. So this DXD has a very logical explanation of it. And at the time, the price was around $44, right? So what is interesting about this, that this DXD was actually up 4% on a day when the Dow Jones was down. And then you have a crazy of all that is a triple, that is a multiple of 3, and that was the S Dow. That was a little bit cheaper in terms of the price. It was only $29 versus $44, while the regular Dow was trading at the time when I took that statistics and sent it to Mark around the 33. It was moving 6%, while the Dow was down 2%. So just be aware of it. That's the way how this thing works. So if I now show you some of these things, like with the market being flat at zero, it would be kind of difficult to explain it, but I'll attempt anyway, like just to kind of point out to you what these things are. So let's just refresh this page, see if we are really negative. Okay, so we're negative about the 0.25%. So if I go to the dog, right? So the dog would be then up. Okay, so then we have here, as I said, it's kind of difficult to show this right now because this is a little bit delayed data. And the bottom line is that this is the daily bar that is green, right? So then you have a DXD that is 4 times of that. It's up. But again, on a day like this, when the market is flat, it's very difficult to show. And then you have the S Dow, which is a triple of that. Now notice the volume on every one of them is in the millions, and we've been open only here a little bit over a couple of hours. So just be aware of it. These are the things that you could trade in your IRA if they don't allow you to go short, or if you don't have option trading capabilities. So what I want to point out to you that I have a same thing here on the NASDAQ, same thing here on the SPX, and same here on a Russell. And I know it's a way too much information to be thrown at you at the time, but I want to point out to you that these that are highlighted in blue, $21, $15, and a $15 at the time when I was trading, those are the cheapest one to trade from all these that are available. So what I'm going to do right now is I'm going to bring in Thinkorswim platform. I'm going to type in here, let's say QID, and the reason why I want to type in the QID because that actually represents the NASDAQ, right? And if that represents the NASDAQ, I can just show you here what we're gonna do with that in the terms of the trading, right? So if I simply go ahead here and buy 100 shares of it at the 24.69, I'm gonna just leave it on. I'm not gonna do anything with it because I'm gonna be teaching something else. The next one that I'm gonna do from my list here, so I'm gonna have an open position on the NASDAQ. I'm gonna move to the SPY, and the SPY has a regular one that goes 2%, SDS that goes at 4%, and then this triple one that goes 6% on a day when S&P moves 2%, and that is currently trading about the $18. I know when I looked it up, that for market was only 15. I'm gonna now go in the SPXU, and I'm gonna just fire the SPXU. So I'm going to show you the volume. This morning it was already 10 million shares. I'm in a paper trading account. I'm going to open this position with the 100 shares, and I'm going to come back to these and address them how they're looking at the end of the session, because right now it's 8:12. So by the time we are finishing around the 9 o'clock Pacific Standard Time, we're going to see how these things are. And then the last I'm going to pick here is not the IWM, but TWM. That's mean twice what the IWM is doing. And I'm going to fire it in. And there's a reason why I'm doing this, because when you see how this thing performs within a short little while, okay, so this one is already up 20 cents on a down day. So it's exactly inverse of what the IWM is doing. So let me just fire this thing in, and I got filled. Okay, so big picture now. I'm going to type in IWM here, which is a normality. IWM is actually down right now. Well, net change 1%, right? So you would see here it's down about $1. While the market is down, I'm able to trade this TWM to the upside. So what does that do to the retirement account? It assumes in a retirement account that you're not short, but you're long because you purchase. Now, what is interesting, you actually purchase something that is inverse, so you're actually profiting from the down move, And this is a concept that a lot of people find confusing, so I'm going to just revisit here one more time, homepage, and refresh here, because usually they always try to have something. So we're continuing going lower. We fill the gap. We're probably going lower on the market. So this inverse of the IWM is then ripping to the upside. So when I go over here in my equities account, I'm going to just show you in the equities account that I have opened these 3 positions. First one that I traded for a 1934 has already gone up to 1940. So that's mean I'm already up about the 6 cents from the time I got in. So let me now just repeat this one more time. You should be looking mark, which means the current market price. This is where we are, okay? And this is where I got filled. So as the market is going down, this is ripping. My next trade was on a QQQ. Which was not on a QQQ, it was on QID. This QID that I'm circling is representing the ETF that is inverse ultra short. And when I got in, it was at 24.69. Now it's already at 24.74. So it's obviously moving my direction as long as the market is going down. This particular trade, QQQ, I shorted 100 shares. to 337. Now it's down at 298, so I can actually unwind this, and that would be a profit. So I don't want to confuse you here. I sold for the higher price, and now I'm buying for a lower price. So when I confirm this, I'm freeing this capital. So 337, I'm covering it for this. Now actually it has ticked up against me because I'm doing it with the limit order. I'm going to just cancel here and replace with the market order just to get out of that trade and to show you that on this particular case there's a profitability because I have sold for 337 and basically covered for 297. So I was in a paper trading account, and now I have a S&P. This SPX is S&P, but the U stands for the Ultra. I got filled on that at 73, and now it's already up almost 10 cents, right? So when you're looking here on a FinViz, obviously what you're seeing that the market is continuing its slide to the downside. And for every little move down, this inverse is actually going up. So if I now go back to that SPXU, you would then observe it that it's up 25 cents. Originally, we got filled at 1873. So this is going out direction. While I'm going to just knock down the U here. Regular S&P is actually down $16, which by the way in the FinViz is a real time. If you're just looking at these indices, if you're looking at anything else, such as the stocks or even the futures, they are delayed. So on a futures over here, when you click in and you look at this, there's going to show you the time, and that time is actually always delayed. So you would go maybe smaller time frames, such as 5 minutes, and then you will see in this area it shows a time, and that time is delayed. So if I have my mouse right here at the current bar of this, and I'm going to just point out to you that if I'm here on the current bar, we are no longer now at this particular time, but when the market was here, it was 11:07 Eastern time, and now it's actually 17. So just be aware of it, that for the indices, it's a public information, it's available to everybody, but for indices, for these three indices, it's a real time, everything else is not. So next topic, I want to teach broken wing butterfly, and what I'm going to do now, I'm going to actually spell out what I'm planning to do, right? I'm planning to look at the S&P, and I'm planning to look at on a S&P, they have introduced Tuesday's option. So this SPX has a Tuesday's option, and I'm going to be doing out of the money bull call that is going to have a out of the money bear call pay for it. Okay, so I'm going to fire the trade in, and I'm going to spend the rest of the time actually explaining it. So what I'm doing right now is looking at the volume of the S&P 500 Tuesday options, which is just a second set that has been listed. They listed the Tuesday options for the first time last Tuesday. And notice I have purposely left these two columns only on the volume and only on the positions. So if I'm doing something that is out of the money, I'm looking here footprints that are pretty big. So obviously this footprint is pretty big. It's about 2,211 contracts traded this morning on a contracts that are expiring today at the end of the session. And then we have another one here at 1,000. That's also 4 digits. I'm going to add a little bit more strike prices here. Maybe I can just type in, let's say, 24 strike prices to see if there's anything even higher than that. And I'm going to then check the UFOs and everything. Okay, so there's a big one up here, 3,000. 2,000, 2,007. So this is where I want to keep my eye. 40,020. So now I'm bringing the platform here with the options set up, and I can evaluate where would that be on a S&P 500? So I have a here SPY. Obviously, if we go here and look from the top to the bottom, we have a 9-day exponential moving average. On a standard deviation, it shows right here that we can be 3 days, according to the statistics, down according to the standard deviation. And currently we are 3 days down. So what my logic is here, that I'm going to have a bull call just in case there's some kind of crazy reversal and we go up. But in case I'm wrong, that bull call is going to be paid by my bear call spread, right? Over here, it shows in terms of the calls and puts. The gray line represents the puts, blue line represents the calls. It's almost irrelevant which one are you picking, and that's why in my strategy, broken wing butterfly, I am planning to pick both set of the trades, but in this case, I'm actually leaning on a call side. So I'm going to change this to the SPX, and the symbol for the SPX is a caret sign in front of it, and then SPX. So that's going to bring it up. And again, the number that I was looking earlier was a 4,200. So if I now look at right here on a daily, I see we have a lot of UFOs here at 4,067. Okay, if I drop it to the smaller time frame, for instance, we can go 4,400. Okay, let me see on a 55. Do we have anything on 55? Okay, there it is, 4,027. And what we were looking here in terms of the activity, and I'm going to just circle this so you guys can see it a little bit better, that we have here a lot of activity in this area right here. From here to here, this is where the real activity kicks in, right? So I want to make sure that these footprints of the institutions that were placed earlier today, and I know they're placed today because I'm looking at the volume. I'm not looking at the open interest. Open interest is something that was done yesterday, but the volume is what they have done today. The question then becomes, who in the right mind, and if I just change this to the intrinsic, so you kind of recognize what I'm trying to explain here, would go ahead and buy this for $8 when it has a $0 of intrinsic value while the S&P is down at 3,985. Somebody who is selling, not somebody who is buying, but somebody who is selling, right? And I want to make sure that you understand that this level, 4,025, 4,030, 4,035, 4,400, all of those options, the higher we go, they change in the premium. Over here, you get the $830. Over here, you get the $690. Over here, you get the $610. Over here, you get... So the further away you go from the value, and here's a value right here, 3,980. And why do I say 3,980? I say it for a simple reason, because this is where currently the market is. And when you're looking right here, the last price is 3,981.90, then you're recognizing that the intrinsic value right here is $1.90 for this particular contract, Now, the contracts that we are considering selling is here 4,000 and whatever, 2025. These are the areas that we are trying to sell, looking that it's a set of the UFOs. So if you're good with that, type in a check mark, because now I want to execute. And when I executed, the rest of the session is going to be just explanation of what I did, right? So I know I'm kind of rushing it, but this is a two spreads combined in one in order for me to get the free spread. So 4,027. I'm going to pick the gut at 4,300. 4,300. Okay. Okay, Mark said okay. So let me tell you, if I'm looking at the bull call, which is the first one, 4,300, and I'm buying to open 4,000 and let's say 25. This is a $5 spread. This $5 spread is gonna give me a debit. Okay, It's going to give me a debit. I think this is going to be way better if I actually put it in a template. So I have these things side by side. So I'm going to have this side by side. So this out of the money bull call is a debit. Okay. And what I'm doing here, I'm creating the lines here. So you would recognize that I'm starting to build from the bottom up. So if I have here a price that I'm buying to open and then selling to open, then on my bear call side, and I want to emphasize that this piece of trade is going to be a bearish one. Okay, I'm going to still use the same unit that I'm selling. And the unit that I'm selling is this one right here. This one right here. This is the unit that I'm selling. Maybe I can actually color it in red. So for all the practical purposes, my trade is centered around this 4,030, because on a chart that would be somewhere within these UFOs. Now, what I'm going to do here with the bear call spread, rather than having only the $5 spread, I'm going to have a $10 spread. That means I'm going to be buying to open 40.40. And in this case, I'm going to get credit. And my goal is to have that credit large enough to pay off my debit. That's my logic. Okay, and I'll walk through this in such a way that you understand it. So the execution is very simple. So right now it's 8:27. Let me show you how quickly this execution takes place. I put the mouse right here at 40.30 at the bid. I single right click. I go where it says a buy, and I go where it says a butterfly. What they do, they fill up the correct information, and I will do it with 10 contracts here. 425, 430. Now, the moment I change this 435 into 440, the color is going to change and it's going to say credit. So I'm asking for $35 credit and I'm sending it in, and I want to see if I'm going to get filled. So I'm asking for the credit of the $35. And if they're not giving it to me, I'm going to just walk it down a little bit. I'm going to walk it down. So I'm walking it down to 30. Usually I wait about 2 minutes. Now be aware of it that since then the market has moved even a little bit lower. 30, waiting. Cancel and replace. Move it to 25. Patience is a virtue. So if I look at here, my cancel orders, I usually wait about 2 minutes between them. I waited only 20 seconds, so that's usually not a correct time to wait. Okay. The only other thing that I can think of to get the better credit is to lower the strike prices a little bit lower, but then I'm compromising my technicals. So I would rather do this as educational purposes only and not worry about violating the technicals. So I'm waiting for a 20, a 25. They're not giving it to me. I'm going to go down to the 20 cents. Okay, now I got actually price improvement of the 35. Price improvement of the 35. So what I'm going to do right now here, I'm going to show you what I got filled. I got filled for this for 35, although I was willing to even take a 20. Okay, so what I'm doing right now here, I'm now going back to my top platform and walking piece by piece. But before I do that, I want to make sure that I take the snapshot, because later on, after the session, I'm going to put everything inside of our live session notes. So just like we had the live session notes on this particular trade with the risk and a graph and everything, I'm going to do that but from the top. So what I'm doing at this point is adding this information here so I can actually explain it and then walk it piece by piece. So when you're looking here, 425 call, this call costed me, had to ask, $5.70. This call that was sold costed me less. Why is that? Well, first of all, this is a debit trade. I buy the more expensive and I sell the less expensive. Well, that's what creates a debit. But now look at this same bid that is 440 now completely changes the picture when I go over here and I sell this for 440, and the top one, this one right here, this one, I'm actually paying only 275. So for this call right here, I'm paying only, I have to ask $2.75. Mark, that's great. You actually got the improvement of the 55 cents versus. Okay, what is the advantage to use the SPX and SPY? Christian, that all depends where you live. In the United States, there's a different tax privileges, the way how SPX is taxed, and I'm not a tax advisor, but I want to tell you, SPX is 10 times greater than a SPY, and SPX is a cash settle, which means you can afford to hold this till the end without ever freaking out they're going to assign you shares. SPX settles in cash at the bell today. The SPY, you might end up in the margin if your account is not big enough to cover all those shares. So I personally find that the SPX has the tax advantages. I know it's 10 times greater, but then I paid the commission less, because if I were about to do this with the SPY, my position would need to be so much greater, and then for each contract I would end up paying still 65 cents, right? So again, when I start trading, I started with the SPY, and then when I got more comfortable, then I got myself promoted to the what was called then S&P 100. The ticker symbol is OEX for that one, and I traded the OEX till about 2007. I think that's when I actually decided I'm able to trade the big one, right? So this is a S&P 100. Now, you probably never heard of S&P 100, but think about it. Christian, I'm talking to you. If you have a 500 employees, honestly, Christian, do you think all 500 are working hard? In any company that has about the 500, there has to be at least 100 that are really, really working hard, and other ones are just having a job, right? So what my logic is here is definitely, if I want to trade the S&P, most likely, I want to trade the best of the best, right? And those are the S&P 100s. Those are the S&P 100s, right? So same thing with the Dow Jones. Dow Jones has 30 stocks, and out of the 30 stocks, like not every one of them is going to be performing that well. So if you now look at, let's say, I'm trying to find a public one for Dow Jones here. You see, you have S&P 100 right now. So if I pull up the S&P 100, out of the 100 of the S&P, right, 66 are declining and 35 are still working. So now you know that that's the case, that even out of the 100, there's a 36 of the outperformers. If I would change this now to perhaps S&P 500, out of the S&P 500, 370 are actually pulling the market down, but only about 129 are trying to push it up. So when I was introduced to this whole concept of the trading the SPY, I said, like, wait a second, why don't I trade the best of the best? And then eventually I quote unquote promoted myself to trade the S&P 500. So anyway, what I want to do with this information, I want to go into the option chain on a top platform and walk you through it so you kind of understand what is going on here. So again, the symbol for This on the top is a caret sign SPX. So there's a caret right in front of it, and it's a SPX. Now be aware of it because I know what I'm already doing. I don't need to be searching too much. I'm going to just go over here where it says edit the spread, and I'm going to add the option leg. So now that I added the option leg, I can manipulate that information to give me exactly what I want. So I'll stick to the one contract buying, one contract selling, but I need to make sure that I'm in correct cycle. So today is May 10th, and I'm doing both of these for May 10th. The lower one is being bought, the higher one is being sold. So I'm going to make this into sell, and I'm going to have this on a buy. So this one that I did was 4,025. So it's completely out of the money. It absolutely would make no sense for anybody who reckons that this thing is so far out of the money to go ahead and to buy this. Then why do we buy this? With intention of the selling the higher one. And the higher one that we sold was at 40.30. At 40.30. So I'm going to just float this for a second, and I'm going to move it out of the way. And then when I revisit the chart, I want to explain this to you. In case we start having these tails, are you recognizing this right now? We're having the tails. That means there's some kind of reversal taking place right now as we speak in the market. Now, could it be that the market has stopped going lower and now it's trying to go higher? Well, let's just look at it here. We have these 10-minute bars that are showing what is called bottoming tails. So we're bottoming up the lower part of it. Could it be that all of a sudden we rip? Well, we have seen yesterday the S&P drop over 100 points. Just because we are down 10, it doesn't mean we cannot now reverse and go up here in that area where we are selling our 40-30 level. It can easily happen, right? So I'm actually trading that with that in mind. So going back to editing the spread, I know exactly where I got filled on every one of them. So I'm going to go here and I'm going to type in the filled price for both of them. Well, Josip, from where do you get the filled price? Well, that's why I took a snapshot of where I got filled. Now, Mark, I know you're at home. If you're doing this, please fill in the numbers that you got filled, because what I got filled is not the same from you, because you got the price improvement. My total broken wing butterfly is giving me credit of the 35 cents. Now be aware of it. For one contract, that is the $35. Now I did the what? 10 contracts. So when you multiply this, we're talking about $350. Now we'll discuss how much money we have put online. I'll come back to that, but I want to first walk this logically through the steps so you understand what is going on. So what do? 570 is the one that we bought. 440 is the one that we sold. So if we know that information, I can actually type that in. So right here, I bought this one for 570 even, and I sold the one for 440 even. So when I click OK, I have that information here, and what I'm going to do next, I'm going to just take this snapshot, because this is where the real learning kicks in. When you have the bottom line, this is the bottom line right here, that it shows you that, oops, we no longer need this. We only need this document, so I'm not going to be showing the other document anymore. That I have got the debit of the $1.30. Now, when you're asking what is the risk, well, the risk is the 370. So you're like, well, that's not good risk to reward. Yeah, but that's not my trade. My real trade is actually what? Bear call spread that finances this debit. Now, another way to show to you that my risk is the 370 is very simple. I'm going to put the mouse right here where it says spread. Single right click, and I'm going to go into the risk graph. And when the risk graph populates, right in this area, I have everything that I need. So this area is what I'm going to again snapshot and put it down here as an explanation of it, that we have that as as a profit. Now, where would the price need to be for me to break even? Well, you would need to add that $1.30 on the top of the unit that you bought. So you bought the unit that is 40.25 plus the $1.30 equals obviously this amount. This right here. This is where it equals, right? So that's where we got that information. So I'll also take a snapshot of risk graph, because a lot of students say like, oh, give me the risk graph and I want to see it now. Of course, that risk graph in isolation doesn't I don't want to say it doesn't make much sense, but be aware of it. It's a part of the bigger picture. It's part of the bigger picture. Okay. So let's now do the second one. And for me to do the second one, I'm going to actually build the second one from a ground up. And the way how I'm building it, I'm going to actually go where it says a bearish, and I'm going to select the bearish call spread. So what this thing is going to do automatically is going to change strike prices, but I will still need to alter this. So when I'm altering this according to my standard, and my standard was to trade today's expiry. Okay, I'm trading it with the calls. The one that we sold was a 40.30, and now notice the one that I'm buying, it's actually 10 points higher. It's at the 40.40. Okay, and because I know exactly where I got filled in terms of this $10 spread, therefore there's a reason why I skip here this strike price. Strike price 40.35 is skipped. Okay, so I skip that, and I don't want to even type it here. You see that this is $10 here, right? So over here, how did I figure out that my risk was $5? Well, basically from a spread of 5, I subtracted $1.30, and I got the risk of the 370. Okay, so let's now remember the numbers, 275 and 440. So the one that we are selling at the fill price is 440. The one that we are buying is 275. I click OK, and here it is. It explains exactly what happened here. $1.65. $1.65. So now you might say, well, this trade doesn't make any sense. For $1.65, my risk is $8.35. Wow, that doesn't make sense. Okay, let's just come back to it. Okay, because we did this as a spread. We didn't do it in isolation. We did it as a spread. So what I'm doing here, I'll just make this a little bit smaller before I dump next to it, the second one. You know what? I'm going to be actually putting it on the top so it's easier to distinguish which one is which. So there it is. So this is the $1.75, right? So how did I come up to this 8.35? Well, easy. Put the mouse right here where it says a bear call spread, single right click, go where it says a risk graph. Now I created the risk graph at a different window because I was floating it. Okay, let's dock here. Oops. Okay, just one second. Just 1 second. Just give me a second here. I shouldn't have done that. Okay, so there it is. Risk graph. There it is. There it is. $835. $835. So probably like. Oops. Let me just move this mouse. This mouse is really on the way. If I put it right there. Print screen. It's very important for me to have all this information so later on after the session, if you're reading the documents, you understand what is going on. So there it is. Okay. Now, why does it say here that my break-even point is the 40.31? Because I'm selling this level right here. So if the price pierces, if the, let's say, S&P 500 closes at 40.3165, I'm still not losing money. And why am I not losing money? Because how much credit did I take in? $1.60. I just need to take one more snapshot here before we move on to the combination of the two. Combination of the two is something that should bring what I like to call a religious experience of epiphany. When a major insight hits you in the head and you are now looking at it almost at disbelief, saying, oh, I forgot the name of this session is options with options. And that's going to happen when I go over here and I pull up the, okay, let me show you how I'm filtering this. I'm going to just type in SPX because I know I traded other stuff there too. So because I've traded other stuff, I'm now filtering only for this. So now I single right click, I create a duplicate order, and now when I go confirm it, I'm looking what is my outlay of the capital. My outlay of the capital is this. This is my maximum profit and this is my maximum loss if I get filled for that much. Okay, so having said that, why don't I now go edit, make this only to one contract, because we are now explaining only one contract. So then it's going to be so much easier for you to understand. So did you see what I did here? Instead of having the 10, I only put it at the 1. So I'm buying one of these 40.25 and I'm buying one of these 40.40, but I'm selling two of these, and that's that broken wing butterfly, right? And now when I go and confirm it, am I risking 1,500 or am I risking only 500? Well, look what the beautiful thing is. I'm only risking 465. So now this right here is supposed to be your, what I like to call, in religious terms, epiphany point. Because when I combine these two things, if I did this bull call spread by itself, it would cost me $1.30, correct? If I did this bear call spread, it would cost me $835. When you subtract the $1.30 from $835, shouldn't that be $705? But that's not the way how the broker looks at it. Broker simply looks at it, and I'm going to add one more line here. This is a 5 debit or the 5 strike prices, right? This is a 5-point strikes. This is a 10-point strikes, spread strikes, right? So all that they do here mathematically on this one, they take 5 minus from a 10, then they get the 5, and then from that 5, right? So when we have a simple math here, let me just go up here. So we had that my bear call, that is a 10, okay? My bull call, that is a 5. Has the difference of the 5, and then they subtract what I got paid as a credit, and then say like just give us $4.65. That's what this thing is. That's exactly what this thing is. So let me now one more time just capture this and put it in, so you recognize that now when you're looking this $465, I think it's clear to you where we got this. Bear call spread is a $10 spread. From that $10, they know that you might be profitable $5 if this is deep in the money and it closes exactly there at 40.30. So then they say like, okay, we don't need that whole money, you know. Oh, and by the way, we don't even need that whole $5 because you got the credit of what? So your your maximum loss is only this amount that I'm coloring in red. But then what's your maximum profit? Well, your maximum profit is more than what you're risking. So Christian, Ahmed, Mark, Joanne, good to see you, Joanne. Um, Jeff, I can't read all the names here. Please type in, how do you like this particular strategy? Do you have any question? I know it's a lot, but the beautiful thing is that if you do nothing, you at least made that $35. But if you let this go against you, and as long as it doesn't go through that break even point, right? We already calculated the break even points on these things, right? These things, we have a calculation of break even points. Then you're fine. This is an excellent strategy for the current environment we are in, right? So right now, we are still bottoming up this area. But then again, what is in New York right now? It's a lunchtime. So could there be movement down, consolidation, and another movement down? Yes. But just in case there's a movement down, consolidation, and a rip your face rally to the upside, I want to make sure that I don't allow this to go above that 40, 31, 65, whatever we calculate. At that point, I would need to manually close it. But when you're manually closing, you're not really losing money on both of them, because if you're manually closing, let's just assume here that we are that the SPX is now at 403165. Would you agree that over here you're making your maximum profit? Because the 425 is then in the money, 430 is in the money. So in that case, your $1.30 that you paid is $5 in the money. Now you can say like, oh, but on this one I'm losing money. As long as you don't let past 40, 31, 65, you're not. That's where this $535 comes from. Now, is it okay if we close this for the less than? Yeah, sure. So what would you need to do? Well, this is the way how you can do this. Like you can watch it with alerts. That this is my preferred way to do it. So I go SPX. I single right click here, and I go create alert. Okay. So I'm gonna be start alerting myself when we approach 4030. That's the first alert. Okay. So somebody is at the door ringing the bell. My next alert is gonna be $1 higher. Okay. Which means at 4031. Okay. 4031. Okay. And then my final alert is going to be, and I'm going to give myself just a 15 cents room to act. It's going to be at 40 to 31.50. Remember, my break-even point is 40.3165. So soon as I start getting on my cell phone these alerts, I know I need to do something about it. But if I don't get this alerts, then why to go ahead here and click this and say, okay, create opposite order, make it at the market when there can be a slippage, it can be all sorts of things that can go wrong, and then do this whole thing that I was showing you before. Let me just see if I can drag this in and make it like a method. Let me just see if I can carry this. It popped up on this other window, and I can drag it in. Okay, so there it is. And then down here, you would need to submit when S&P is at or above at the market. Exit me at 40.31.65. Okay, 65. 65. Okay, so I'm gonna proofread this in a moment. Just make sure that we're right here. So if this S&P rips and it goes to 40.3165, right? Then at the market just close me, whatever that is. So bull call would definitely have a, I don't know, $5, $4, and whatever the value is, depending on the time when it hits, because there's other components there besides delta. And the bear call would be then going against me, right? So just be aware of it. If I send this in, that should not get filled right now. That should be there just as a working order. So there it is. This is sitting as a red. When I got filled, it was sitting as a what? As a green. Of course, it needs to quote something. Right now, it's quoting 40, right? But what is more important than anything on my market watch, I have these alerts down here for the S&P that I have sent in that are waiting at 3 different levels. So we have about 5 minutes before we finish up. I want to one more time repeat what we did in this session. So we have started answering the question that Mark emailed to me about how do you protect your IRA, and then I talked about the inverse. And in fact, we went ahead and we placed in Thinkorswim paper trading account few of these trades. And if I go right now and compare how is that doing. So this one right here is protecting me by being up already 30 cents from where I got in. So if I want to take this off, which I said I will at the end. So I'm going to confirm. So what I did, I first bought, now I'm selling. So that's supposed to be on IRA seen as a good thing. Now notice, the moment I did this, I'm out of this TWM. So if I'm out of this TWM, I can go into profits. And I just want you to focus on the TWM. Don't look at anything else, just the TWM. So what I'm doing right now here, I'm actually just focusing on the TWM. That quick little trade made it $32. Okay, but I'm not done with it. Okay, I have other stuff in it. Okay, so what other stuff do I have in it? Well, I have equity on QID. I got it at 69, now it's at 68, now it's about 2 pennies, okay? So maybe I can leave this one open because it's not as profitable. But this one has made me almost additional $20. So what I'm doing here, I'm closing this, okay? I'm gonna just put it at the market because we're gonna close here. We're gonna close this session here. Bingo, done, okay? So now when I go down here, I'm not gonna look at the IWM, I'm gonna look at the what did I exit there? SPXU, right? So that's the trade that we were trading this morning, XPXU, and that made me $14. So $14.32. So that's it. And then this last one, as I said, like, oh, now it's going a little bit against me, which means what can I expect on a chart? On a chart, I can expect a tick up in terms of the NASDAQ. So here's the NASDAQ, and guess what? It's no longer at these lows. When we started the session right here about an hour ago, we're at the lows. Now it's trying to go up. So anyway, so we are now done. I want to thank you once again for attending the session. I will post these notes soon, and bye. Stay hedged.